if you look at ESG factors, we really see environmental risk as the tip of the spear. So whether it's just the recent bankruptcy and the 40% market cap loss of PG&E, or whether it's the Volkswagen emissions scandal where they couldn't tap the debt market, public debt markets for 18 months, 40% also loss of market cap, a multi-billion-dollar fine from the DOJ. So I call it the tip of the spear because I think it's environmental risk is perceived. Insurance companies are starting to price it in. Everyone's starting to price it in. Very interested over time in environmental reward, not just risk, but also social risk and reward, and that is something that you are touching on. I would say the elephant in the room here is that externalities, both positive and negative, are not priced into the market, and that is where the Milton Friedman-esque model, short-term shareholder value creation starts to break down, and I think you start seeing some of this happening. That said, we're in a very precarious time if you think about the protests in France around trying to price carbon, which has been repealed by the French government because it felt that the tax was unduly burdening the least enfranchised. I think that it's really important to think about how to price externalities very, very thoughtfully. But I think that that's just a concept that is in a way embedded in what we're all saying.
I mean, sorry, please do.
Yeah, you nailed it. And the thing with the environment is you've got better data, so you can do those things more easily. You know, you've had 20 years of environmental data disclosure and a real focus on the E. There's been very little focus on the S. And there's just not enough data. And companies are themselves really trying hard. I mean, the companies we talk to and engage with, there's hundreds of them. And, you know, they're not bad people. They want to be better at many of the things that we're focused on. They don't, you know, I don't know how many Fortune 500 CEOs know how many of their employees are on food stamps. I bet you they don't know. So getting the data is the first step. You got to get reliable data where we can compare companies the same way we do it on financials. You know, we've had, 100 year of evolution of financial disclosure. We'll go in the same way with these other factors. We'll be much smarter about how we price these things in.
I have a theory on why no one's focused on the E. If you think, or rather the S, the E, you can think of fines and risk as you talk about. The G, governance, is sort of allocation of capital decisions that management make. And those are ones that economically you can very, line of sight on why you want to invest in a company that has great policies that apply those. Within the S, I think stability of the workforce, let's start with that as one of the issues, and how both men and women are treated at all levels of the firm. Private firms do a great job. It's much more of a family-owned businesses take care of people. There's a long history, and there's a long history of stability. And in public corporations, you're more of a number. And so, but when you solve for that, and when you have an appropriate way of addressing and working with your employees at all levels, you're lowering headhunter costs and turnover and downtime and training and all of that stuff, which does lead to or reduce earnings. So I mean, it's just that you need to actually have that data.
In the short term.
Yeah, I think over the long term as well. I mean, if you're having constant turnover of employees
I think you said reduce earnings, but I think you meant reduce
No,
costs.
I think you're by creating stability of the workplace, you're increasing earnings, you're reducing a cost. And it's not something that people have focused on.
Yeah. Right. So I'd like to ask each of you, if somebody's thinking, I mean, some imaginary person, if they're running an impact investing fund, or if they're thinking of impact investing in some way, what are the concrete steps they should be taking right now to prepare themselves for continued economic and political turbulence? We're in an industry that's meant to be doing things for the long term, that's meant to be stepping away from a short-term shareholder value as its metric. What are the defensive measures or preparatory measures you should be taking? Maybe just mindset things.
I'll just frame it from the as an investor looking at what products are available. So if you're saying we face headwinds and potentially a market downturn, people become defensive. Most people don't time things well, but let's say they allocate their cash differently. That's an area where there isn't a ton of inventory, particularly when we're talking about the average investor. The choices are the traditional money markets that have never been very exciting, or certainly not since the late 90s. And with that in mind, that's probably a great opportunity space for impact investments because you can, whether it's something like Calvert Notes or C Notes or whatever it might be, you can find products that operate or look like traditional cash allocations that maybe offer some sort of regional social impact. But the challenge is vetting those, and do they scale, and often they don't. So there's an inventory challenge. But that would be one place if I was building a product that certainly from a timing perspective, there's going to be people that want it. A secondary challenge, though, not just inventory, is liquidity, because I've heard a couple panelists talk about microfinance loans, and they're incredible, but they aren't accessible for all investors, and or they're not something you can allocate to if a portfolio has liquidity needs that are shorter term. But with that said,
Again,
that's
for some
certainly-
people, yeah.
We view the risk, I'm sorry, Martin.
I know, I'd like to mix it up. I'll jump around.
Sure, sorry.
Otherwise, I end up going up and down the row, you see.
We view the risk as very similar, if not identical, i.e. if you're investing in public equities that have an ESG lens, and you will be aided over time by the fact these are really quality businesses with quality management teams making change that's aligned with your values, but also will end up leading to a better, more sustainable business. That's the good side. In a harsh recession, you should assume that there will be very little, if any, benefit. I mean, that's what I think we've learned time and time again, that businesses sort of get valued in brief periods of time with parity and with a similar lens. That creates an opportunity to tilt your portfolios and do things at that point. The private markets are a different area, but we view it as you need to have an understanding of balancing your portfolio, aligning liquidity or illiquidity with your needs, and understanding the risk you're actually taking. You're not going to be bailed out by good intentions of management teams and the decisions you're making.
Martin?
I would probably say the same thing as if you'd asked me how to prepare for a bull market. I think you need to, if you're an impact investor, you got to figure out, what do you believe in? What is your North Star? Like, what's your strategy? I would say that to anybody in this room. Figure out for yourself what it is you're trying to do, and develop a strategy from the top down that gets you to where you want to get to. Across all asset classes, you want to have great, risk return criteria. You want to have great impact. You want to measure that. You can do that. Impact investing is like driving a car. You can do it well. You can do it really badly. So I think you can set your, figure out what it is you want to do, set your targets, and stay the course.
Okay.
I'm going to say something that's less popular. I mean, I know that's what my dad tells me that. And I think that...
Well, that's probably good advice. If it's
yeah, exactly. I always listen to my dad. But I just wonder, exploring a little bit about what Michael talked about earlier, and then I camped on around wondering if a market downturn could potentially flush out the kind of weak ESG actors, and wondering that plus the fact, and it's something that you alluded to, that I think there are a lot of impact capital that's sort of on the bead. And Michael, you probably see this in your business, where folks are thinking about going in but not going in, wondering if a recession scares them off, and wondering if that is a kind of a short-term buy opportunity where there's almost like a misperception of risk. We see ESG as a risk mitigant, but I think the market at large sees this as more risky, despite this prevailing track record and data set that we have. And so wondering if it's, on the public side, maybe not a time to double down on ESG in the areas that you have conviction.
I think that's a really interesting distinction. I think it's one of the many disconnects between the people who run companies and the broader population who look at those companies, is that distinction between ESG as a risk mitigator and ESG as a costly bauble to have in good times. And I think there's a whole load of things that are like that, and they're part of why we are today, minus the center ground. Okay, I'm going to open up to some questions from the floor. Who have I got? Everyone gets very quiet towards the middle of the afternoon. Everyone's digesting busily, I think. Actually, this is a fantastic panel. We've got some great panelists here, so I'm just convinced that we have got some questions. Good. Okay. Yep, you're on.
Question for Michael.
Which Michael?
Pardon me, Michael Tiedemann.
You can say Michael in the middle, or you can...
Michael in the middle.
Yeah.
What are your thoughts, please, on the TPG, KKR, et cetera, impact funds, given your comments just now on private markets, et cetera?
Sure, meaning large entrants? Is that the brand name? Well, it's funny, I went to a conference this summer and there were a lot of smaller entrepreneurial, and I was I think it was sponsored by KKR, and they gave a presentation. It was a bit of a sales pitch and presentation, but it was, it was well done. And then I sat around and talked to 5 people, and they said, I can't believe they're here. This is, and I said, look, guys, they're going to be the buyers of the businesses of yours. That's the food chain. Don't hate on them. Just sell them your business in 3 years. Like, And they were like, that's a good point. I was like, it is a good point. It's like, it's all capital. Anyway, I think I know some of the principals in both firms quite well, and I know it is a very real, TPG in particular. They want it to cut through all components of their business. They're also extremely commercial. All these firms are very successful, very commercial, and they've, in the case of TPG, they've put almost $2 billion to work in a year and a half, and they want to come back to market with another big fund. So they're not going away, but I do think they're both sincere and capitalists. I think, but so are many of the entrants in the space.
Just 2 quick comments to camp on. If you look at the magnitude of the capital that's being raised, if you are looking to put out $1 billion or $2 billion or $3 billion, the bite size, the average investment size is as large or larger than the average impact investing venture capital fund.
Yeah.
And so, well, I think you're right that these can be kind of buyout or secondary, tertiary funding sources. I believe at this stage in the market, that deal flow needs to be made. It's not found. The way it is in venture capital, you can go, fishing on Sand Hill Road and find a bunch of deals, or Silicon Beach or near MIT. I think that the deals that have the absorptive capacity of $50, $100, $150 million, which is the sum of the bite sizes that TPG made in their first fund, need to be made. That's one thing. And the other thing that we look at is our hope that there is a trickle-up effect. So for funds or firms that raise money, whether it be incumbent funds, firms that raise impact funds like KKR and the ones you mentioned, and Bain, wondering if over time, presuming that they're successful, and if we believe that the market will shape the way we have the conviction that it will, that over time these funds, that there's a trickle-up effect of the kind of infecting the mothership with impact. So it's not kind of an impact carve-out. And ultimately,
There's more a lens right across.
Yeah, exactly,
Yeah.
and hopefully a positive lens,
Yes.
not a negative lens.
Yeah, okay. Do you have another question? I do have a hand here, yes, thank you.
Hi, Jamie Martin, Morgan Stanley. I think question for Martin, although others can jump in. We certainly think a lot about this idea of democratizing access to impact investing. We can argue all day about whether or not you can have impact within public market investments. I'm just wondering kind of some lessons learned perhaps from the GIST ETF that was launched, and how that has kind of resonated, and given that it is an ETF type structure, if you're finding new participants in the market as a result of that innovation.
Thank you.
Thank you. Yeah, so we launched an index a couple of years ago. Goldman Sachs licensed it and then launched the Just ETF last June. And it has somewhere in the region of $200 million in assets. So I spend a lot of my time meeting with regional RIAs, family offices, institutional investors on the ETF. I think, I would say there's just a lot of interest in allocating to products that make it easy for investors, easy for them to understand, easy for them to describe to their clients. Just's own experience is different because we're a nonprofit, so we can be much more transparent about all our data and our methodology. That helps. I think people, in my experience, absolutely want to know what's under the hood. Come back to the data question, like why is that company in their portfolio? You have to be able to answer those questions. And, you have to be able to really, sort of meet investors where they are. That's been my experience. So, I just try to bring, as I said, we don't really think of ourselves as an ESG fund, but, we certainly have, an objective, a mission, as well as financial performance. And so I think just being able to tell that story in a simple way, oftentimes impact investing is so complicated. It's really hard to explain. And I think many people would like to do more, but they're fearful a little bit, partly because they probably don't understand it. And you have so many people sort of in the sort of the value chain, the supply chain of bringing fund products to market that also don't necessarily tell the story the best way. So anyway, so I sort of feel like you got to have the performance numbers. That's table stakes. And then you have to have a story that people will understand.
We have a. Oh, I'm sorry.
Oh, I just want to piggyback off of, absolutely, they've got to have the ability to access it. And more than that, I think there was a panel earlier, what would you do with $1 billion to make a huge impact? I would take 1% of it for a massive ad campaign and purchasing program to get sustainable investment products into retirement accounts, because that's where the vast majority of this country has its, the average investor has their dollars. And not every retirement account allows access to the Just ETF or to a mutual fund or ETF that has a specific focus on this. So
that's a really nice example.
there is really not enough access in the place where people have most of their money. So there's a long way to go in terms of probable asset growth as that changes, and it might happen because of what Fran said, which is maybe you have a market pullback, we see who's wearing swim trunks, and then those funds get added to these plans.
And other Michael?
I agree with you, by the way, because you look at Fidelity and Schwab, they're beginning to do it. They're doing their work, and now they're beginning to provide some solutions. So I think some of what you're saying will be certainly part of the next 10 years, but to date has not been. That's a very good point. Regarding complexity, because I think you're exactly right, there's sort of lots of pieces. And one of the tools that our team developed that helps create, I think, simplify it, is really, it's a diagnostic tool that essentially a family will take, and it allows them to collectively identify what their family values are. It's a really interesting exercise. It's very interesting to see how everyone in the family varies or is completely aligned. But then the output of that shows you what that puts out, and then also how it can tie to a portfolio. And so that's our attempt to solve for the complexity, because if you begin talking about the pieces and just the themes, of which there are many important ones, and there's a lot of passion around those themes, you get lost in the weeds, and then you really can't do something more comprehensive.
Interesting.